Joining us now to discuss is Jason Thomas. He's Director of Research at the Carlyle Group, who is out with that new report on private investing. Jason, thank you so much for joining us. This is not so encouraging for some of these private companies that are looking to go public.
Well, I think there's actually quite a bit of demand for IPOs. The issue is the issuers. It's the companies that are deciding that they would prefer to remain private. And so I think that's an important distinction. If we look back 20 years ago, companies with over $500 million of market value really had no choice but to go public if they wanted additional capital, if they wanted liquidity for their founders. Today there is a choice, and it's a choice to go with private capital instead. And because of that avenue, you've seen a shrinkage of the public markets, down by 55% over the last 20 years, both in the US and globally. And you've also seen a 75% decline in IPOs. But again, I would consider that decline to be attributable to the issuer side rather than the demand side of the equation.
And the offsetting statistic to that, which really stands out, is the enormous growth in the total amount of private capital.
Exactly, and so it's extraordinary growth in private capital, but I think what a key message from the Carlyle Research report is that it's not so staggering when you consider the growth in the number of companies that are private. So today, there's about 8,200 companies backed by private equity in the United States. That's twice as many companies that are listed on public exchanges in the US. So that gives you some sense of the relative proportion. Again, if we were to go back 20 years ago, public companies in the US were 4 times as numerous as those backed by private equity. So again, I think that helps contextualize the growth.
We've clearly seen a big growth in the private equity industry, and we've seen perhaps a bit of a shrinking and certainly some consolidation in the active asset manager, public market industry. But maybe not to the extent that you'd expect given the statistics we just spoke about in terms of the companies to invest in. And very different skill sets are needed to invest in those two areas. So what is the takeaway from that? Is there anything going on underneath within the industries that we can extrapolate from?
Well, I would say on the private side, there's much more focus on growth, on underwriting for growth, on being able to deliver growth. That means industry expertise, more fundamental research, also expanding geographic reach, and just, again, being able to deliver growth platforms. On the public side, I think that there's a sense that what people want are passive allocations, but it's passive allocations to a greater number of indexes. So the number of indexes to which you can gain exposure in public markets via passive vehicles has absolutely exploded, and that's been the main driver of the increase in AUM that's managed by ETFs and just passive vehicles more broadly.